All right, let's dive right in. Today, we're looking at a really powerful and honestly personal story about the risks of investing. And this isn't some dry academic theory. This is a real world lesson that was learned the hard way, shared by an investor who found out that some mistakes, you only need to make them once.
Come on, we've all been there, right? You see an opportunity, and it just looks too good to be true. A trade that feels like a guaranteed win. It is so tempting to just jump in with both feet. But what if that temptation is actually the biggest risk you can take? So our story kicks off with a very specific, timely problem. An investor is looking at the price of gold, and they're trying to figure out what to do next. So right off the bat, instead of rushing in, this investor is showing some serious caution. They're basically hitting the pause button, waiting for some big economic news from the US Federal Reserve. And the big question is, why? This investor isn't just guessing. They're even thinking about a pretty sophisticated strategy called a strangle option, which is a way you can potentially make money whether the price goes up or down. This tells you they're an experienced thinker. But even with all that knowledge, their core message is still one of extreme caution. Okay, so what's really the logic behind all this hesitation? Let's unpack why this whole idea of a sure trade is just so, dangerous. Here's the chain of logic. It's like a domino effect. First, the Fed makes its decision on interest rates. That decision then directly impacts the value of the US dollar. And since gold is priced in US dollars, its price is directly affected. It's a clear three-step ripple effect. This really shows that internal battle every single investor faces. On one side, you have that emotion, that temptation telling you to buy when a price looks low. But on the other side, you've got logical caution whispering, hey, wait for all the facts, because there are much bigger forces at play here. And this right here is the crucial point. It's the anchor for this entire argument. You simply can't analyze the price of gold in a vacuum. You have to consider the currency it's priced in. Forgetting that one simple fact can be a very expensive mistake. And now we get to the heart of the story. You see, this caution isn't just theoretical. It was born from a painful, real-life experience. Wow. This is a powerful admission. The author is telling us they've been in this exact spot before, believing in a sure trade, and it led to some serious regret. They fell for the very temptation they are now warning all of us against. And here's the specific mistake they made: going all in. They didn't just invest, they put everything on the line, betting it all on a single outcome they believed was a certainty. And this is the devastating result. This wasn't just about losing money on a spreadsheet. The consequences were hunger and homelessness. The author is sharing this incredibly vulnerable part of their past just to stop others from making the same mistake. That belief in a safe trade, it cost them everything. So let's be crystal clear about what we're talking about here. A sure trade is a myth. It's a dangerous fantasy. As the author states directly, the very idea that a trade can be a sure-done safe deal simply does not exist in the real world. This painful lesson leads to a simple but absolutely non-negotiable rule that applies to every single person who invests. 1. That's all it takes. One mistake, one all-in bet that goes wrong is enough to wipe you out completely. It doesn't matter how many times you were right before. That single time you're wrong can be the end of the game. And just in case there's any doubt, this rule is universal. It applies to beginners who don't know the risks. It applies to experienced investors who might get overconfident. It applies even if going all in worked for you in the past, because that might have just been luck. And here's the big one. Even if you think you're diversified, putting all your capital into the market at once is still going all in. This is the core philosophy of survival and investing. The goal isn't just to win, it's to stay in the game. It is so much better to take a small, manageable loss and live to invest another day than to risk everything on one trade and have nothing left. Okay, finally, let's broaden the lens a bit and look at the final takeaway from this powerful story. Remember that strangle option we talked about at the beginning? Well, even that isn't a sure thing. If the price of gold doesn't move enough in either direction, those options can expire completely worthless, and you lose your entire investment on that trade. There is no magic strategy that eliminates risk. And this leads to the final piece of advice. Don't get so focused on one asset, whether it's gold, a hot stock, or crypto, that you lose sight of the bigger picture. Falling into that kind of tunnel vision means you miss both other opportunities and other risks. So we'll end with this question, just to really let the message sink in. After hearing this story, it seems like the most dangerous thing an investor can do isn't picking the wrong asset, but rather believing that any asset is a guaranteed winner. Perhaps true wisdom lies in accepting uncertainty and managing risk rather than chasing an illusion of safety.